NPM 2441206. Class Accounting 24A. Journals in Accounting Systems. Definition of a journal. Journal is the first book of entry in the accounting system used to record every financial transaction in chronological order, based on the date when the transaction occurred. Each transaction, supported by a source document or form, such as an invoice or receipt, is then recorded in the journal before being posted to the ledger. In other words, a journal is the place where all transactions are recorded systematically for the first time, including the date, account names, amounts, and short explanations about the transactions. Functions of a journal. The journal plays a crucial role in the accounting process. Its main functions are: recording function. It records all transactions in chronological order to ensure that nothing is missed. Historical function. Since transactions are recorded by date, journals provide a clear history of financial activities. Analytical function. Each transaction is analyzed to determine which accounts are increased or decreased, debit or credit. Control function. Journals help control and verify whether every transaction has been recorded correctly. Information function. The information in journals is used to prepare financial statements such as income statements, balance sheets, and cash flow statements. Types of journals. In accounting systems, there are two main types of journals: the general journal and the special journals. A. General journal. A general journal is used to record all types of transactions that do not fit into any special journal. It is often used for adjustments, corrections, and infrequent transactions. Examples of transactions recorded in the general journal include: depreciation of fixed assets, adjusting entries for accrued expenses or income, correction of recording errors. Example of a general journal entry. Date: November 1st, 2025. Transaction: paid building rent of 3 million rupees. Journal entry: rent expense debit, RPM 3 million rupiah. Cash credit, rupees 3,000 rupiam. B. Special journals. Special journals are used to record frequent and similar transactions to make the recording process more efficient. There are four main types of special journals. Sales journal, used to record credit sales of goods. Example: sold goods on credit to a customer worth RPM $5 million. Purchases journal, used to record credit purchases of goods or raw materials. Example: purchased supplies on credit worth 4.00 million. Cash receipts journal, used to record all cash inflows, such as cash sales and collection of receivables. Example: received cash from a customer worth 2,000 million rupiahs. Cash disbursements journal, used to record all cash outflows, such as payments for debts, salaries, or operating expenses. Paid employee salary worth 1,500,000. Structure of a journal. Every journal has a simple structure consisting of: date of transaction, when the transaction took place. Accounts involved, the names of the accounts that are debited and credited. Amounts, the debit and credit amounts, which must be equal. Explanation, a short description of the transaction. Number, an optional code or page number for posting to the ledger. Journalizing process. The process of recording transactions in a journal involves several steps. The source documents, such as invoices, receipts, or cash vouchers. Which accounts are affected and whether they increase or decrease. Decide which side to record, debit or credit. The journal entry with the correct date and explanation. Entry to the ledger, transferring the data into the related accounts. Example of a journal entry. Case. November 5th, 2025, the company received cash from a customer worth rupee 1,000 real for payment of an outstanding receivable. Analysis. Cash increases, debit. Accounts receivable decreases, credit. Journal entry. November 5th, 2025. Cash, debit, Ramba 1 million rupiah. Accounts receivable, credit, rupee 1,000 million. Explanation. Received cash from a customer for payment of receivable. Benefits of using journals. Journals provide a systematic and organized record of all financial transactions. They help in preparing accurate financial statements. They serve as a control tool for monitoring business activities. They make the auditing process easier because all transactions are properly documented. Conclusion. The journal is the foundation of the accounting system. It ensures that every transaction is recorded accurately and in the correct order. Without journals, it would be impossible to create reliable ledgers or financial statements. Mastering the process of journalizing, accountants can maintain clear, organized, and accountable financial records for any business.